The New Zealand share market, it underperformed last month. A weaker earnings season resulted in a drop of around 1%, which is in stark comparison to overseas markets like the US, whose markets rose by around 5%. Now, thanks to our friends at Milford, we've got Milford Asset Management Analyst, Investment Analyst Michael Luke joining us. Thanks for coming in. So the NZX, it's underperformed compared to those global markets, and there was a weak earnings season. What have we learned over the last month?
Yes, so you're right. The NZX did underperform last month, down just under 1%, and flat year to date, which is a bit disappointing compared to markets like the US, which was up 5%, and over 10% this year. Now, that really reflects, I guess, the relative performance of our economies, where while all countries are dealing with much higher interest rates, the effect in New Zealand has been really intense. Our economy is really exposed to interest rates, given our housing market. And we've seen consumers really cut spending and businesses have to cut costs in response. Now, that really came through in reporting last month, particularly those companies exposed to the economy like tourism holdings.
Yeah, I mean, let's talk about tourism holdings because they're a company that does motorhomes, I think, and you'd expect them to be doing quite well. It's post-COVID, a few years beyond COVID, international tourists are coming back, the airlines are coming back, but they're not doing too well.
Yeah, so tourism holdings, they build, rent and sell motorhomes, and the rental part to tourists is going really well. However, local demand to go buy a motorhome has really dried up, and that saw the company cut their earnings guidance by about a third with only 2 months to go in their financial year. So consumers are really cutting spending on things like motorhomes and travel.
Wow. Can we talk about the housing and construction sector? Because we've talked quite a lot about that on this show, and it's taken quite a big hit at the moment, lots of companies going down and all of that. But Fletcher Building, which is, it's a big behemoth, isn't it? That's been impacted.
Yeah, so Fletcher Building's share price was down 18% in May, and that was on the back of a weak trading update where the company basically came out and said they now expect earnings to be down significantly compared to last year, and that's on the back of lower construction activity. We've also seen the weak housing market weigh on retirement village operators like Ryman Healthcare. So retirement village operators were big beneficiaries of a rising housing market, and now with the market weakening, they're having to cut costs and pause some projects in order to reduce debt.
It's a shame that they're not doing well because they've always been the ones that have been doing quite well. Yeah. Is there any good news in this? Are there any silver linings?
Yeah, so there's winners and losers in every market cycle, and we still saw strong results from companies with really strong competitive positions or strong tailwinds. One example is Fisher Paykel Healthcare. Now, they're actually the largest company on the New Zealand share market, and they're a global leader in medical devices for respiratory care. Now, Fisher Paykel delivered a good result, and they've been getting some really good market share gains in recent years following the launch of a number of new products. So they're taking market share in areas like masks for sleep apnea, as well as respiratory care in the hospital.
Not to be confused with the Fisher Paykel that builds ovens and all of that as well. In terms of an outlook, what's the outlook for our economy and the NZX?
Yeah, so I think that the reality is that many households and businesses are doing it tough right now, and that's likely to continue until the Reserve Bank starts cutting interest rates, which would remove some of that pressure, but also I think improve sentiment that things will get better. However, it's important to remember that share markets are forward-looking, and investor expectations right now are incredibly low. In fact, many of the companies exposed to the local economy, their share prices are now below 2008 or GFC levels. So looking ahead, we think companies with strong competitive positions will keep doing well. And there's also likely opportunities with some of those companies that have been beaten up by the economy that might do a lot better in a couple of years once the conditions improve.
You talked about interest rates coming down there. They're going to take a long time to come down, right? It's going to be a slow decline. It's not going to be, cool, cost of living's under control now, we're going to go back to 2%. It's going to take a long time.
So it really comes down to inflation. And what we've seen recently in the New Zealand economy is that conditions have really eased, but inflation is taking a bit longer to come down due to things like insurance and council rates. So currently the market's expecting that the Reserve Bank starts cutting interest rates in February next year. However, if inflation did keep falling, that could be brought forward. And if things really drop off, you could see faster rate cuts than you'd expect.
Interesting stuff. Thank you very much. Thanks for coming in. That is Milford Asset Management Investment Analyst Michael Luke. And we're talking business every Tuesday and every Thursday thanks to our friends at Milford.